And 3, 2, 1. What's up, brother? We made it through.
Hey.
We made it through 4th of July weekend. First week of July.
Yes, we did. Yes, we did.
You're coming home soon,
We're approaching
right?
the Ides of July.
All right. I need my partner back in the studio, man. It just feels so distant.
Yeah. I am conflicted. I mean, it's kind of nice out here on the beach, bro. Just gotta tell you.
All right. Well, I'm gonna order some rain and some cold weather, and then you'll come back.
Exactly.
All right, man. What you got for us this week?
So, I don't know about you and everybody else listening, but I'm getting a little tired of this bear market. And tired, unfortunately, is not a term that signifies a bottom, right?
Right. That's a good point. Just because I'm tired of it doesn't mean it's going to go away.
Right. It doesn't. And so there's exhaustion, which basically is now, right? People are tired and they wish it would go away. That's not a bottom. Then there's capitulation, right? That's like what we saw at the end of really 2008, right? Bottom in 2000, end of 08, 09, when things really started pounding down really fast, and we got a V bottom, and everybody just dumped everything they had, and we got a V bottom. Apathy is really what happens when you get to like a long-term bottom. Like that was more 2003. Market was down 50%. It just kept. It wasn't for quite a while. It was going sideways at that bottom, and it was already down 50%, and it was just draining everybody. Nobody wanted to talk about stocks anymore. They were apathetic. That anybody would talk about football or the weather or anything other than stocks, right? And that is the sentiment basically that signifies a bottom. Most people
forget that the market is people. We think of it as companies, or funds. It's people. People drive the market. So when the sentiment changes, people's behavior changes, and when their behavior changes, the market changes.
Yeah. And the bad side of sentiment is that by the time you personally get around to realizing that, oh, we're back in a bull market again, you've missed most of the move. Right. And vice versa. I mean, it doesn't take very long to see if you're using technical analysis, charting, it doesn't take very long to see that the market rolled over and the trend changed. Right?
Yeah. But if you're using sentiment.
It takes much longer, right? Like right now we're 6 months into it and there are still plenty of people that think, I'm good. And as long as I keep hearing that sentiment of no, it's good. I know that we're not at the bottom yet.
Right. Yeah. That in the charts.
Oh yeah, that in the charts. Well, yeah.
But really, I mean, when you put those two together, you are getting a sense that is data, right? And so that's the takeaway from this is like, if it's all doom and gloom, and you're watching the charts, you're gonna be there watching the trend change. That's the idea, right?
Yep. I mean, that's what they pay us to do, right? Is to assess the sentiment and the data, and then what, if you're a subscriber, you'll get alerted when we reallocate our personal TSP accounts.
Yep.
And we're doing it based on that data in the charts. Okay. TSP Weekly Update Show, 10 July 2022. So one of my favorite tools is Fibonacci Retracements and Extensions. We're going to go do a pretty good deep dive into Fibonacci. So try not to let your eyes roll in the back of your head because it's really one of the best tools going. Then we're going to take a look at Apple again. We did this a couple weeks ago, but Apple is pretty important right now. What we talked about a couple weeks ago is that Apple represents the biggest chunk of the S&P 500. Of the 500 companies, Apple is so big. I want to say it was like 10%. So basically whatever happens in Apple really drives what happens in the S&P 500. And then we'll take a look at the TSP 2.5-year weekly charts. All right, so Fibonacci, we'll get a little bit of intro into who the guy was, but seashells, he came up with this sequence that kind of defines how things are in the universe. If you Google Fibonacci, you can find as many people that believe sort of the concept of what we're going to go over here. They believe it as absolute truth, and there are plenty of people that try to debunk it. So if you want to go down the Fibonacci rabbit hole, have at it. You can kind of see here the idea of it is it works in spirals, and we know the Elliott wave count, right? It goes up in 5 and down in 3 waves. So you can't really see the core, the beginning, but as the spiral moves out, you can see that you get 5 waves up, 1, 2, 3 down here. You get 5. You get would be a 1, 2. This will be a 3, 4, 5, which will hit the next part of the spiral around like that. So the idea is that you use each spiral on the Fibonacci spiral as a target. Okay. And so let's just get into it. So Fibonacci retracements are ratios, and they're used to identify potential reversal levels, which is really important for us right now because we want to be able to when we get these little bear market rallies that we're arguably in right now, we want to have an idea of potential targets of how high those rallies might go before they start rolling over, right? So the ratios are found in the Fibonacci sequence. Most popular Fibonacci retracements are, it's 61.8 and 38.2. Most people round them off as the 38% and the 62% retracement levels. So after the market moves up a bit, you can apply the Fibonacci ratios to define retracement levels. And it says here forecast. I kind of like the term target. Forecast implies a crystal ball, and that is not the point. But it gives you a target to expect some kind of correction or a pullback. And then Fibonacci retracements can also be applied after a decline to, again, forecast or target the length of the counter trend bounce. These retracements can be combined with other indicators and price patterns to create an overall strategy. I would say they absolutely must be combined with other indicators, and obviously have to be combined with the price patterns to create an overall strategy. Not that I would, take issue with anything that they say up there at school.stockcharts.com. But I think must is a better word there than may. Okay, so I basically cut and pasted this out of that school.stockcharts.com article. So the article is not designed to delve too deeply into the math behind the Fibonacci sequence or the golden ratio. Again, you can go down the rabbit hole, but there's some of the basic stuff will pretty much give you a really good idea of how we're going to use it in terms of TSP. So Leonardo Paisano Bogallo, 1170 to 1250. He was super smart, arguably the smartest mathematician in the Middle Ages, Italian mathematician from Pisa. And I'm sure a lot of you guys have heard this idea of reproducing rabbits is kind of where this whole thing came from. And the sequence comes from, you have a 0, the next number is 1, and then when you add these two numbers together, so when you add 0 and 1, you get 1. When you add 1 and 1, you get 2. When you add 2 and 1, you get 3, and it keeps on going, right? To infinity, okay? So that's how the base of it works. And as you extend it into infinity, you get all kinds of unique math properties. And one of them is this thing called the golden ratio or the golden mean or phi, okay? So there's basically two numbers, 1.618 and 0.618, okay? And those two ratios are found all over the place in nature, architecture, biology. If you ever seen the swirling of the universe, it swirls, stars swirling in the universe as a Fibonacci sequence. And so the the way you get to that 1.618 or 0.618, if you it works best if you use the higher numbers. It doesn't really work if you use the lower numbers. So if you divided 89 by 55, you would get almost 1.618. If you divided 144 by 89, you would get almost exactly 1.618. And the further out you do it to the higher numbers, the closer you actually get to exactly 1.618. If you divided 55 by 89, so the reverse of it, right, you get 0.618. So if you do the higher over the lower, you get 1.618. If you do the lower over the higher, you get 0.618. And for whatever reason, those two ratios are everywhere in the universe. We talk about Robert Prechter's book, Elliott Wave Principles, all the time. His quote from there, the proportion of 0.618 to 1 is the mathematical basis for the shape of playing cards, the Parthenon, sunflowers and snail shells, Greek vases, and the spiral galaxies of outer space. The Greeks based much of their art and architecture upon this proportion, and they called it the golden mean. So how do we use that in terms of stock market, or particularly in TSP? So what we want to do is find alert zones. I like that title a lot more than forecasting. So a retracement, when we say retracement, right, we're down here on this chart we had a bottom, right? The market had been coming down. We hit a bottom, and then we had an advance. Okay, the market came up. This piece right here is called the retracement. So the value of this move was, 17 to 26. And then it retraced, whatever percent of this move. Okay, so when we say retracement, that's what we mean. This is the move that you're looking at, and it retraced some percentage of that move. Okay. So how far is the market likely to retrace after it comes off one of these big moves? That's what you're trying to use the Fibonacci tool to figure out. So retracement levels alert traders or investors of a potential trend reversal. So trend reversal, resistant area, or really important, an area of support. So retracements are based on the prior move, which was this. This is the prior move, and this is the retracement, right? A bounce is expected to retrace a portion of the prior decline, while a correction is expected to retrace a portion of the prior advance. Once a pullback starts, chartists can identify specific Fibonacci retracement levels for monitoring. As the correction approaches these retracements, chartists can become more alert for a potential bullish reversal. Okay, so we're looking at Home Depot back in 2009. So Home Depot hits a low here on March 9th, 2009, and we get a really good rally. Okay. Eventually, the rally tops out right here and starts to roll over. So if you take the Fibonacci tool in stock charts and you say, okay, here's the bottom. So I start there and I use the tool to pull it up, and these lines automatically come up by using the tool. I pull the tool up to the top that I'm looking at. So here's here's what the 100% is from the low to the high here. Okay. So if you want to know how far the retracement goes, if you start here and the whole move took you to here, right? If it retraced 100%, you would be back down to where you started, right? Does that make sense? If you retraced 50%, it's a 50% retracement or loss, we say, right? So the difference between here and here is 50%, right? So what happens a lot is retracements tend to complete at Fibonacci levels. So what this chart of Home Depot is showing, the advance started here at the bottom, and the advance ends here at the top, and you use the tool to pull it out, and you're looking for where is this retracement going to end. Okay. So you can see it blew right through the 38.2 retracement level. Okay, that was right here. So price didn't stop there, but it did stop right on that 50% retracement level. Okay. So these are zones. They're targets. It's not like a floor. It's just one piece of data that you use in combination with other things. And this is actually a good one. If it blows through that 38% level, your next target is that 50% level. If it blows through there, your next target is that 62% level. Okay. And ideally, it'll line up with the other technical indicators that you're using. Okay. So the inverse applies to a bounce, right? So in this case, so it's the reverse of what we just saw. If the market comes down and we're looking to see how far does the market come back up or retrace this down move. Okay, it's exactly what we did the last time. It's just the opposite. So the inverse applies to a bounce or corrective advance after a decline. Once a bounce begins, chartists can identify specific Fibonacci retracement levels for monitoring, right, for a target. As the correction approaches these retracements, chartists should become more alert for a potential bearish reversal. So this is really where we are right now in terms of TSP, right, in terms of the market, because we had the top here in January. We have had a pullback, and we're still waiting on a significant recovery rally. But if you watch in the financial media at all, everybody's expecting this recovery rally to get us back up to some level before it rolls over again. So one of the kind of takeaways, I guess, not from this chart specifically, but conceptually, most people think that the next significant rally we have will recover back to some level. And so what we'll be looking for is, does it recover back to that 38% level, 50%, or the 61.8, right? Or if it recovered all the way back, then we'd be going on to new highs. So these are the targets that we'll be looking at whenever this recovery rally happens. So in this case, it got up to that 38% retracement level, blew right through it, and then actually got a little bit above the 50% before rolling back over. So they're targets, and that's why they call it an alert zone, and it's not a hard number. So keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for potential reversal. It's at this point that traders should employ other aspects of technical analysis to identify or confirm a reversal. These may include candlesticks, price patterns, momentum oscillators, and moving averages. We talk about that every week on the show. And the more of those you can line up, if the 200-day moving average was doing like this, and the 50% retracement level is here, there's a lot of resistance here, right? So until we get above this line, you should be skeptical. You should expect it to hit resistance and keep going down because the prior trend was down, right? It's patterns within patterns. Okay. So the Fibonacci retracement tool at stock charts shows 4 common retracements: 23.6, 38.2, 50, and 61.8. So we didn't talk about the 23% at all because it's not really one of the most common ones that you see. If you do get a 23% retracement, it's a very shallow correction, and so honestly, that level probably wouldn't get us pushed out of the market anyway. But anything between the 38.2 and the 61.8, which the 50 is in between, they're important. And they stem from the Fibonacci sequence. So the 50% retracement is not a Fibonacci number. But the Dow theory asserts that the averages often retrace to half their prior move. And I mean, personally, the way I look at that is, if you lost half your money, or your drawdown is 50%, you've about had it, and you throw in the towel, and that's when the market takes off, because everybody basically says, I lost half my money, I can't take it anymore, I'm getting out. And that's why 50% is I think Charles Dow identified that, but it's not a Fibonacci number. So based on depth, the 23.6 retracement is pretty shallow. These retracements are appropriate for flags or short pullbacks. So that's an example of something where if the market retraced 23.6% or in that area and then consolidated sideways, it should continue in the same direction of the prior trend. Usually it's up when if it pulls back that 23.6%. And you'll get a flag or some kind of short pullback or whatever. Retracements in the 38 to 50% range are considered like a moderate correction. And if it's deeper, the 61.8 retracements are referred to as the golden retracement. And that's really the level that you should expect to have some significant support. So golden retracements, there's a whole bunch in this chart. I just wanted to take a look at a couple of things. So this is Pfizer, and it's near its 62% retracement level, which this is what they're talking about right there, right? It wicked down. So it's a daily chart. So intraday, you have that wick right there that broke through that 62% level, but on the day before, it closed a little bit above it. On this day, it wicked a little bit below it, but you can see all this churning right there at that support level. And then once it comes up, gives us like 4 days of consolidation, right? And then you got a big breakout. That's definitely the time to buy it based on the Fibonacci analysis of it. And with the addition of, we had a little recovery from there, a little bit of a consolidation, and a big breakout on, where is I? Pretty big volume, higher than the day before. So it's, obviously the breakout worked. So Fibonacci's are definitely good, but you gotta apply other technical analysis tools to validate it. Okay. Fibonacci retracements often used to identify the end of a correction or a counter trend bounce. Corrections and counter trend bounces often retrace a portion of the prior move. If it's going to be a short correction, it often pulls back to the 23.6 level. The 32 to 61 zone covers most of the possibilities, with obviously the 50% would be in the middle. The zone seems kind of wide, but again, it's just a reversal zone. And you absolutely have to use other technical indicators to confirm any kind of reversal off the Fibonacci levels. Reversals can be confirmed, candlesticks, momentum indicators, volume, chart patterns. The more contributing factors, the more robust the signal. So the more likely that support is going to hold. Right. What does this look like in real time, and how can we do it? So this is the Dow Jones Industrial Average as of the close on Friday. Okay. It's I don't know, what is this? 5-year weekly chart. And so all I did was start down here at the COVID low. I used the Fibonacci tool to pull up to the top in January. Okay. And so right now on this 5-year weekly chart, where each tick, each vertical line here is 1 week of price movement, the Dow Jones Industrial Average, which is not our S fund, a lot of people get that confused. The Dow Jones Industrial Average is 30 big companies in the US. The S fund is the Dow Jones Total Completion Stock Market Index, and people get them confused for some reason, but they're not the same. So anyway, we're looking at the Dow Jones Industrial Average, and it has pulled back right to that 38.2 retracement level. And it's been bouncing on it for the past 1, 2, 3, 4 weeks, right? So can it break down below 3,000 and continue down to the 50% retracement level? Absolutely, that could happen. Could it find support at that 38% retracement level and start moving higher? Absolutely. So if I'm looking at this right now, I would have drawn a trend line here, right? We would have moving average lines, we'd have this trend line, and we're saying, okay, one possibility is we get support at that Fibonacci retracement level, right? That 38% retracement level. And we have that. So check that block right there. The next thing is we want to be above this downtrending, this down sloping trend line, right? So if price can get back above that down sloping trend line, ideally on big volume, then the support level is probably going to hold. It increases the probability that support level holds, and then that's where you want to buy it. I wouldn't buy it until it got above that trend line, because the overall trend is down. So it's at this point, until we can get some validation for that Fibonacci level, it wouldn't surprise me at all if we keep doing something like that. And then even if we do get support let's say we do get support here at this 38% retracement level, we get a recovery rally. Okay. So then you would start here, pull the Fibonacci tool down to this bottom, and now you're looking for the 38, 50, 62% retracement, this move. You're looking for the retracement of the move down to see where this top would be, because that's where you would want to sell it if the market's going to come down and continue a bear market. Okay, so hopefully that makes sense. We just that little part right there just jumped onto kind of Fibonacci 201, but that's how you use it. Okay,
201. We're not quite to grad school, but it's not your undergrad class. Yeah.
No, I mean it's pretty basic, but it's the more complicated you can make it very complicated, but it doesn't have to be.
Yeah, and honestly, like what I don't worry about the why so much. So if you're watching this and you're like, some people like to understand, why it works, and I understand why, because I hear you explain it. But if you go into your favorite chart software and you do like Jerry did and you pull those little things up, you don't really need to understand why. That just gives you another data point, another analysis tool that you don't have to understand the math. Just if you accept that it works, then you're good, right? And so it's good to know why. But if you use the tool, it's really easy, and you can just accept that it does.
Yep. And again, it's not a crystal ball. It's just another tool to give you a target for where you might expect some support or resistance. That's all. All right. Apple. So I know this chart is a little bit busy, but there's a lot of things on here that I think are worth talking about. We did Apple a while ago, and we talked about how Apple is the most important component in the S&P 500, which is our C fund. And so we said, if you follow the direction of Apple, you're gonna know which way the C fund is going. The red and black ticks, okay, so the red here are down days, the black here are up days. Those candlesticks is the price of Apple on this chart. The black line, the black solid line, is the S&P 500, okay? It's the C fund. So you can see the black line follows almost exactly with the price of Apple, which makes sense because Apple is the driver, right? The blue line is the 20-day moving average of the price of Apple. Okay. So forget about the black line now, because all I wanted to do was show you that the Apple price and the S&P 500 price are in lockstep. Okay. That's the only reason I put that S&P 500 line on there. So forget about that for now. Pretend it's not there. The other important piece is the blue 20-day moving average line for Apple. Okay. So we had a bottom in June. We came up, tried to get above that moving average line. We're up there for a couple of days, rolled over and put in a higher low. Okay. So we did a retracement, right? We put in a low, we came up, we retraced about 50% of that move, got support, and Apple moved higher. So Apple moved higher, and on this day where the green dotted line is, it closed above that 20-day moving average line. Also on that day, we got above 50 on the RSI. We got right at 100 on CCI, and MACD had already turned positive. And then for the next 2 or 3 days, Apple continued to move higher. Okay. So Apple's pulling the C fund. Apple actually, when did I do this? 3:15 on Friday afternoon. I'm not sure how Apple finished the day. The S&P finished down a few points, but it was pretty much flat. But Apple is definitely pulling the C fund higher. So what I'm kind of watching for Apple right now, if the blue line continues like that, and Apple can pull back and get support there and bounce higher, right? If we get support there and volume starts increasing, which right now volume is decreasing as price is going higher, so that's not a good signal. But overall, the Apple chart is pretty bullish. So if we get a pullback on Apple to that moving average line and a good breakout from there, it's very likely that the C fund continues moving higher. We're going to have resistance up here at 152.50 on Apple because of all this back here. So even if it does continue higher for the next few days or week or so, it's going to have a very tough time getting through resistance right there. But we shall see. So watch Apple because it's a pretty good proxy for the S&P 500 in general. Okay. All right. TSP fund charts. We've been looking at these for months and months, and not too much has changed. As long as the price of the C fund is below this 20-week moving average line, we cannot have a sustained rally. So, this is great. We are higher than we were at the June low. We've had 4 weeks of kind of an uptrending consolidation. That's good. We'll see if it can continue. If we drew a trend line, we're pretty much at it. We'll see. None of the fundamentals look good. My expectation is the market continues lower, but I don't really care about my expectation. I only care when we get it back above this 20-week moving average line, then it's more or less safe to get back in the water. And at that time, you'll also see RSI getting back above 50, because like we show all the time, once RSI gets back above 50, it stays there, right? Until it doesn't. And it breaks down, and then it stays below 50, and you don't want to be in the stock funds when RSI is below 50. Okay. S fund, same exact thing. We had a breakdown below that 20-week moving average line. It was earlier on the S fund. It was back in November of last year. And ever since then, every time price tried to get back above that line, it couldn't do it. And again, we got pretty good 4-week consolidation here, right above 1,500. But until we get above that 20-week moving average line, there's no point in being in the S fund. Same kind of thing here. We are above 50 RSI all through here as price goes higher, and we are below 50 all through here as price comes down. So this stuff does not have to be complicated. You can look at it once a week like we're doing on the show, and as long as we're below 50, don't be in the S fund. I fund, same thing. There's some other indicators you can look at on the I fund. I think it was the last Facebook Live I did, talked about the inverse correlation to the I fund and the US dollar. So as the dollar continues to get stronger, the I fund will continue to go lower. So one of the things you can look at in addition to RSI and the 20-week moving average line on the I fund is the movement of the dollar. So when the dollar finally rolls over, that's when the I fund is going to start to pick up. But you will see it when it happens in RSI, and eventually price will get above that 20-week moving average line also. F fund is a little bit disappointing. There's a lot of talk about bonds, they're so, I think this week I read a stat where, this high, from this high in bonds to this low, this is the biggest drop off since, you have to go back to, I think they said 1785 to have a fall off that bad in the bond market. It's kind of unbelievable. So basically this is the
not
worst.
1985.
That was 1785.
1785.
I mean, it's mind-boggling how
that?
bad this move has been in bonds. Yeah.
Wow.
Which just means that at some point it's going to snap back in the other direction, right? And we were looking at that last week, right, as a potential beginning of that snapback. RSI was starting to move higher. There was a little bit of a divergence, right? Divergence is a great observation if you can see it. So we had a low here, and we had a lower low here. So as price is decreasing, you would think that the momentum is also going down. But here, momentum was down here, and momentum is increasing as price is decreasing. You see that? That's divergence. And so that's what generated this big move up last week. Unfortunately, the Fed came out, the job numbers came out this week, and unemployment did not increase. So the job market is still very strong, which implies that the Fed is going to continue to raise rates because it's trying to push down inflation. And as long as the job market is strong, inflation will continue to move higher, and the Fed will continue to raise rates. It's a big circular mess, and you can really see it play out in the bond market. But for our purposes, I was kind of hopeful that at some point the F fund would get back above this 20-week moving average line based on this divergence, and we didn't get that this week. We got a rollover in price and an RSI, so it's a very good possibility.
Not a strategy.
I mean, I hope as much as anybody else, but I make my reallocation decisions based on what the chart says. That's it.
Questions. That was a good one, man. I know a lot of people kind of, glaze over a little bit when we get into that real technical stuff, but I mean, this is an educational show. That's what we're here for. And, we're trying to put those tools into perspective for the TSP, right? So there's a lot of places you can go to learn about Fibonacci and other analysis tools, but what we try to do is show you how you can use that, relative to TSP.
Right.
And so hopefully you guys get, a lot of good value out of that. If you have questions.
Yeah. If you don't understand it, if you want me to make it simpler, I don't know how much more simple actually it would be. I've had people ask before, like, hey, can you whittle that down into something that shorter or whatever? I mean, I don't, this stuff, you're right. It's an education show, and it takes a little bit of work, and I'm boiling it down to as simple as I possibly can, but it's not going to be a 10-second soundbite,
Right. 10 seconds takes that long to spell it.
Right. Fibonacci? Yeah.
Right. I don't even think I could spell it unless it was in front of me. But if you do have questions, make sure you put them in the comment section wherever you find the video, whether it's Facebook, YouTube, anywhere. And if there isn't a comment section, you can always shoot us an email at support@growmytsp.com. The support crew will forward that on to us. If it's something about your personal finances, we may not be able to answer that, but otherwise we can discuss things. And so we love getting comments. We love getting feedback. Feel free to do it. If you like the show, share it with your friends. If you don't like the show, share it with your friends.
Share it double with your friends.
Yeah. All right. Hope you guys had a good time, and we will see you next week. Anything on the way out, Jerry?
Whoa. I think we're good. Where did we go? One thing on the way out, the market is in a downtrend. It's going to stay in a downtrend until the trend changes.
And there's really no reason to be in the TSP. Check it out.
It's tough to if you're in the stock funds right now, it is rough. But
go have a beverage. Go have a beverage. Forget about it. Don't stress over it. Watch the show and we'll tell you when the trend changes.
Exactly.
All right. See you guys.
Out of here.